Okay, welcome to the deep dive. You've brought this really fascinating stack of end-of-year headlines and research. We're doing a bit of a hard-hitting investigation into the final economic picture for 2025.
We are, and it is, frankly, a dizzying picture.
It really is a study in contradiction.
Exactly. I think our mission here for this deep dive is to really synthesize what happens when, macroeconomics, regulation, and these massive capital deployments all collide in the last few weeks of the year.
So we're looking beyond just the surface numbers.
Way beyond. We need to understand the tension points. I mean, you have these major market games fighting constantly against, well, a lot of political noise and this really deep, unsettling regulatory uncertainty.
It feels like the economy is sprinting towards a record finish line while somehow tripping over its own feet. So let's unpack this.
Absolutely. The tension is palpable.
Okay, let's start with the markets. You could look at Monday's trading and, think everything was pretty quiet heading into the holidays.
Right, a slight dip.
Exactly. Stocks slipped a little as the year winds down. The S&P 500, for instance, it dropped about, 0.3%? Mm-hmm. And the Dow and Nasdaq composite followed suit, both down roughly 0.5%.
But that daily movement, that is the deceptive calm. You really have to look at the bigger picture.
And within that context?
The context that really matters is this. Despite that minor slip right at the end of 2025, the S&P 500 is still up more than 17% for the entire year.
17%?
Yeah, and we are tracking toward an 8th consecutive monthly gain. That is a truly remarkable run. It suggests the underlying investor sentiment is powerfully optimistic.
So we have a market that's fundamentally bullish, shaking off the day-to-day volatility. But what about the mechanics? I mean, the things driving that optimism?
Well, that leads us right into the bizarre economic tightrope the Federal Reserve was walking for most of 2025.
It seemed like an impossible mandate.
It was. It really was. We know the Fed cut its benchmark interest rate 3 times later in the year, and that's typically a move to boost growth, calm the market.
Yeah.
And when they cut rates, you naturally see Treasury yields fall. The 10-year yield, for instance, dropped from 4.13% to 4.11%. That's just standard monetary physics.
But the cuts weren't happening in a vacuum, were they? It felt like the Fed's traditional tools were sort of broken. They're cutting rates to ease conditions, but they can't ignore these other threats.
Exactly. And here's where the complexity really comes in. Those rate cuts were happening in an environment of persistently high inflation and a job market that was it was clearly showing signs of slowing down.
Okay, so there's the bind. If they cut rates, they risk reigniting inflation.
Mm-hmm.
But if they hold rates high, they could crush the job market and tip the whole economy into a slowdown.
It's a perfect illustration of the limits of central bank power in this kind of fragmented economy. And that leads directly to the third factor we have to talk about, the political noise.
Right.
Monetary policy is supposed to be shielded from politics for a reason. I mean, its effectiveness really rests on market trust and its independence.
And yet, the sources we have here detail this very direct, very public tension. We had President Trump publicly stating he might sue Fed Chair Jerome Powell for incompetence.
And that kind of rhetoric is just highly destabilizing. It's not just a passing comment. It introduces a layer of political uncertainty directly into the central bank's operational decisions.
So investors are left wondering.
They're wondering, is the Fed making a decision based on data on inflation and employment, or are they worried about external political threats? This friction, between economic reality and political theater, it makes forecasting stability for 2026 incredibly difficult for you, whether you're managing a multi-billion-dollar portfolio or just your own retirement account.
Okay. That's the tension at the macro level.
Yeah.
Trillion-dollar markets, political brinkmanship. Now, let's pivot dramatically. From high-stakes risk at the Fed, we move to, high-stakes risk at the consumer level. A fundamental physical change in our currency that created immediate chaos.
The U.S. penny.
The abrupt elimination of the U.S. penny.
This is truly fascinating. It's a decision driven by pure governmental efficiency that just ran headfirst into the messy reality of how people and businesses actually work.
And the facts behind it they're pretty clear. President Trump moved to eliminate the coin back in February. The reason, the absurdly high cost of minting them.
Yeah, the government was spending, 3.7 cents to create a single 1-cent coin.
It's just indefensible from an economic standpoint. So the final production run happened last month.
And yet, the irony is that the moment that decision was announced, the entire efficiency argument just collapsed into total disorder. We saw U.S. retailers and banks reporting widespread penny shortages before the final production run was even done.
So the coin was already disappearing.
The physical coin, despite being declared obsolete, was already vanishing from circulation. It was creating this tiny liquidity crunch at the smallest level of commerce.
You're right. It just highlights how much the entire consumer infrastructure was reliant on that tiny, undervalued piece of metal. And now businesses are just sitting in this regulatory void.
Desperately trying to figure out how to handle cash transactions. What do you do when something ends in 1, 2, 6, or 7 cents?
And this is where the system starts to fracture, right? Because there's no immediate, uniform federal solution. So the states are trying to step in.
Creating this crazy patchwork of local guidance.
We saw New York lawmakers proposing to mirror Canada's rounding standard,
Yeah.
round up or down to the nearest 5 cents.
Right. And then Georgia and Utah, they issued their own non-binding guidance.
Which is fine for a small local business, maybe,
Yeah.
but it's a catastrophe for any multi-state retailer.
Oh, absolutely. Imagine a national chain trying to program 50 different rounding rules into their cash registers. Miscalculation could trigger class action lawsuits or just waves of consumer complaints.
Which is why the call for uniformity is so loud. It's a unified chorus, actually. The American Bankers Association, public affairs groups, they're all urging the federal government for a quick, uniform federal solution.
Because the complexity is just massive. And the sources capture the human element of this perfectly, this unexpected moral dilemma that people are facing just trying to run their businesses, honestly.
Yeah, that quote from New York State Senator James Sanders Jr. was really striking. He said, "The people I've been speaking to are honest souls, and they just want to know the right thing to do in a penniless society."
Honest souls.
It makes you stop and think, doesn't it? We got rid of the coin for a 3.7-cent efficiency saving, but in doing so, we introduced confusion, regulatory risk, and a moral question into every cash register in America.
That is the unintended consequence, valuing efficiency over actual function.
It connects right back to our core theme. High-level decisions have these profound consequences on the ground. Okay, so let's leave the checkout line chaos behind and shift our focus to where major capital is moving, where the money is flowing. Let's talk about the infrastructure that will power the next phase of the economy.
We have to be talking about AI.
AI. If the penny story shows us where regulations caused friction, this next section shows where future-focused capital is flowing, and aggressively.
You have to look at SoftBank Group's huge move here. They announced they're acquiring the digital infrastructure investor DigitalBridge Group.
In a deal valued at what, $4 billion?
$4 billion. It's a massive commitment. And what's really fascinating isn't just the dollar amount, it's the stated motivation.
Right.
SoftBank is explicitly looking to expand its AI-related portfolio. They are willing to pay a 15% premium, that's $16 per share, for DigitalBridge. This tells you exactly where the big players are placing their most aggressive bets.
It's a classic picks and shovels moment, isn't it?
It is. Only the picks and shovels are data centers, fiber optics, all these connectivity assets. The sources make it clear. Regardless of the stock market's daily jitters or the Fed's confusion, the physical infrastructure that processes AI models is seen as one of the most secure, high-growth investments out there.
They're betting on the physicalization of computation.
That's a great way to put it. This deal, it values the equity at nearly $3 billion, and it's expected to close next year. It just makes the point that while we debate the ethics of AI, the financial world is simply buying the concrete needed to house it.
Okay, so this focus on future digital resilience brings us to the core challenge facing our traditional infrastructure.
The electricity grid.
Yeah.
Which struggles not with a lack of demand, but with the high cost of capacity and safety.
This is where that fantastic restaurant analogy from the sources comes in.
What?
What is the core economic problem facing electric utilities right now?
It's all about the cost of excess capacity, and it's driven by the absolute necessity of safety. Think about the U.S. electricity grid, like a restaurant that has to be open 24/7.
Okay.
Now, that restaurant must always be staffed and equipped for the single busiest hour of the entire year. Let's call it the dinner rush on New Year's Eve, metaphorically.
So the grid is built for peak demand, those few days in the summer when everyone's running their AC or the coldest days in winter.
Exactly. And the rest of the year, that capacity just sits there, idle. But because a power outage can be literally life-threatening, it can shut down hospitals, stop water pumps, utilities have to operate with an extreme bias against risk.
They have to be fundamentally conservative.
They do. And that conservatism means constantly building more poles, more wires, more power plants, just to guarantee the power stays on during those brief peaks.
Which is safe, but it sounds incredibly inefficient. That cost for infrastructure that sits idle for, what, 95% of the year, it has to be paid for somehow.
And that's precisely why it drives up rates for customers. You, the ratepayer, are paying for that safety factor, the security of knowing that when demand surges, the lights won't go out. It's an essential cost, but it's an inherently inefficient system from a purely economic view.
So the opportunity for utilities and for investors is finding a way to safely maximize the use of that capacity that's already been built.
That's the whole game. The economic opportunity lies in leveraging that built-in excess capacity, that unused infrastructure, to try and stem the increase in rates. Supporters argue that finding new technologies or smart grid management strategies, it can take the burden away from utilities and their ratepayers.
So it's an effort to turn a necessary safety cost into an economic asset.
Right. It's the opposite challenge of the penny. Instead of removing a unit because it costs too much, we're trying to squeeze value out of an existing, very expensive asset.
So as we wrap up 2025, we've tracked some major intersecting themes. We saw macro instability with the Fed's difficult mandate colliding with political pressure.
Right, and then regulatory chaos born from a quest for efficiency with the penny.
And then finally, this aggressive flow of investment into digital resilience, while traditional infrastructure struggles with the high costs of physical safety.
The common thread, really, through all of these headlines is the enormous difficulty government and massive corporations have in aligning high-level, efficient policy with ground-level functional reality.
Which brings us to our final provocative thought for you to mull over as you head into 2026. We started by noting that the government eliminated the penny because the physical cost of minting it, 3.7 cents, was deemed too high for a physical coin. So if that physical cost was the tipping point, what unexpected non-monetary societal costs, like the sudden regulatory vacuum we talked about, the mandatory switch to digital payments, or the erosion of institutional independence, what costs are we now willingly accepting in exchange for that perceived governmental efficiency?
It's the hidden transaction, isn't it? It underpins so much of modern economics. We often sacrifice stability and simplicity for the promise of technological or fiscal optimization. Definitely some food for thought as we head into a new year.
Thank you for joining us for the deep dive. We'll see you next time.